history is rarely a perfect guide to the future, and what you want to know now is what might make you some money in the second quarter and beyond. Well, one strategy that has paid dividends in recent years is to invest in companies that pay dividends. But our market guest tonight says that approach is so 2011. He's Seth Masters, Chief Investment Officer at Bernstein Global Wealth Management. Mr. Masters, welcome. Good to have you with us. Why are you down on dividend-paying stocks as an investment strategy right now?
Well, they've simply gotten quite expensive. And that's because, as you said, they were extremely popular after the 2008 crash, really. A lot of investors who wanted to stay in stocks but wanted something relatively safe within the stock market felt that higher yielding companies were a safer version of stocks. And as a result, they've outperformed the rest of the stock market over most of the last 4 years.
So, Seth, what should people do if they have their portfolios loaded up with these blue chip, high quality companies that pay good dividends? Can they still hold on to them for a little bit longer, at least for the next couple of months? Or do you suggest that they unload them right away?
Well, I think it would be an excellent time to look at all the other things that there are in the stock market that are right now, we think, quite a bit more attractive. And here's an easy way to think about that. Dividend-paying stocks that have relatively high dividends historically have been about a third of the total capitalization of the S&P 500. Today, they're almost 45% of the broad market index. And usually, things like that are cyclical. Things that have done really well and have become bigger and bigger in the index tend to revert back to their long-term level. And that means that the rest of the stocks, the other 55% of what's in the market, is likely to outperform, we think, going forward.
From what you just said, I can infer that you think that indexing and index funds then, that sort of mimic, excuse me, the S&P 500 are overvalued as well.
Tyler, that's a great point. Absolutely. Look, indexes sometimes outperform, sometimes don't. It's just an index is just another portfolio that happens to be built by the S&P or another index provider, and right now those indices are rather dominated by high dividend yielding stocks. And I do think that when we look back at today from perhaps 2-3 years in the future, that we will find that this will have been a very good time in the next couple of years for stock pickers.
All right, well, tell us a little bit about where investors should be picking their stocks. I know you can't give us specific names, but give us some guideposts of where to put our money for the next couple of months.
Well, I think the places that are going to be interesting are the places that are the opposite of perceived safety, right? Dividend yield is perceived to be safe. What's not perceived to be so safe is things that have a lot of growth and can be exciting, or a lot of value because they can be very cheap. So let me give you an example of each. In the value domain, right now, we think there are lots of opportunities from stocks that were really hit hard because of 2008. So for example, the residential real estate market was the source of the problem in 2008, really. And the companies that were most involved with it were hammered over the last few years. And now some of the stocks in that domain, including some of the lenders who financed real estate, some of the title search companies, some of the home builders, we think actually have pretty attractive outlooks as a stock to own because they've become so cheap.
Forgive me, Seth, as we run out of time here, I thought the home builders had been on a pretty good run. Some of them have more than doubled over the past year, if my recollection serves. So if you tie that thought together with a thought on growth companies for us.
Right. So in the growth domain, I think there are a number of areas which are very interesting. One of them is in energy. There are lots of companies that are in the oil field service area in particular that we think stand to benefit dramatically from the explosion in production of tight energy, both oil and natural gas, that is unfolding across the United States, and we think will continue for the next many years.
Very interesting. Seth Masters, thank you very much for your perspective tonight. Seth is Chief Investment Officer at Bernstein Global Wealth Management, and we appreciate his being here with us tonight.